Imagine waking up 10 years from now and realizing that you missed the greatest wealth building opportunity of your lifetime, not because you weren't smart enough, not because you didn't work hard, but because you were too afraid to start. Every single day, millions of ordinary people are building wealth quietly in the background. They are not financial geniuses. They are not sitting in front of 6 trading screens. They simply understand one powerful principle. Owning pieces of great businesses over time creates freedom. And here's the truth. Most beginners don't realize the stock market is not a casino, and it's not just for rich people. It's a tool. The same tool that allowed early investors in companies like Apple Inc. and Amazon to turn small investments into life-changing wealth. But you don't need to go back 20 years. You just need to start today. Now maybe you're thinking, I don't have thousands of dollars. Or what if I lose my money? Or I don't understand how stocks even work. That's exactly why you need to watch this video until the end. Because in the next few minutes, I'm going to break everything down in the simplest way possible. No complicated jargon, no confusing charts, just a clear, step-by-step roadmap for beginners. You'll learn what a stock actually is, how much money you truly need to start, how to open your first investment account, what beginners should buy first, and most importantly, how to avoid the costly mistakes that keep most people stuck. By the end of this video, you won't just understand investing, you'll feel confident enough to take action. And remember, starting small is not a weakness. Waiting too long is. So if you're serious about building real wealth and taking control of your financial future, let's get started. What is a stock? Let's start with the most basic question. What exactly is a stock? A stock simply represents ownership in a company. When you buy a share of a company, you are buying a tiny piece of that business. That means you become a partial owner. If the company grows and becomes more profitable, your ownership becomes more valuable. For example, when you buy shares of Apple Inc., you own a very small portion of that company. You don't run it. You don't work there. But as the company grows, launches new products, and increases profits, the value of your shares can increase too. Companies list their shares on stock exchanges so the public can buy and sell them. In the United States, the 2 biggest exchanges are the New York Stock Exchange and Nasdaq. These are simply marketplaces where buyers and sellers meet. Stocks make money in 2 main ways. First is price appreciation. If you buy a stock at $50 and it grows to $100, you've doubled your investment. Second is dividends. Some companies share part of their profits with investors in the form of regular cash payments. Now here's something important. Stock prices move up and down daily. That's normal. Short-term movement is driven by news, emotions, and market conditions. But long-term movement is driven by company growth and economic expansion. Understanding this changes everything. You're not gambling. You're partnering with businesses. And over time, strong businesses tend to grow. Why investing early is powerful. The biggest advantage beginners have is time. And time is what makes investing powerful because of something called compound growth. Compounding is when your money earns returns, and then those returns start earning returns too. Think of it like a snowball rolling downhill. At first, it's small, but as it keeps rolling, it picks up more snow and grows bigger, faster and faster. Historically, the S&P 500, which tracks 500 of the largest US companies, has returned around 8 to 10% annually over the long term. That doesn't mean every year is positive. Some years are negative, but over decades, the trend has been upward. Let's say you invest $100 per month starting at age 25. With an average 8% return, by age 65, you could potentially have hundreds of thousands of dollars, even though you only invested a small amount each month. That's the power of consistency plus time. Now, compare that to saving money in a traditional savings account earning 1% or less. Inflation slowly eats away at your purchasing power. Investing, on the other hand, gives your money the chance to outpace inflation and grow. The key lesson here is not about getting rich quickly. It's about starting early and staying consistent. The earlier you begin, the less money you actually need to invest because time does the heavy lifting. Waiting 10 years can cost you more than you realize. That's why starting today, even small, is incredibly powerful. How much money do you need? One of the biggest myths about investing is that you need thousands of dollars to begin. That's simply not true anymore. In the past, buying stocks required large minimum investments. But today, most brokerages allow something called fractional shares. That means you can buy a small portion of a stock instead of a full share. For example, if a stock costs $500 per share, you don't need $500. You can invest $50 and own a fraction of that share. This has made investing accessible to almost everyone. Realistically, you can start with as little as $10 to $100. The amount matters less than the habit. Building the habit of investing consistently is what creates wealth over time. However, before you invest, make sure you have an emergency fund. Ideally, you should have 3 to 6 months of living expenses saved. This protects you from needing to sell investments during a market downturn. Another important concept is consistency. Investing $100 every month is more powerful than investing $1,000 once and then stopping. Automatic investing helps remove emotion and keeps you disciplined. So if you've been waiting because you thought you needed a large amount of money, that excuse is gone. You don't need to be rich to invest. Investing is how people become wealthy. Step by step, how to start now. Let's get practical. Here's exactly how you start. Step 1. Choose a brokerage account. A brokerage is simply a platform that allows you to buy and sell investments. Popular beginner-friendly brokerages in the US include Fidelity Investments, Charles, Schwab, and Robinhood. These platforms offer commission-free trading and easy account setup. Step 2. Choose the right account type. For beginners, there are usually two options. A standard individual brokerage account gives you flexibility to invest anytime and withdraw anytime. A Roth IRA is a retirement account that offers tax advantages. With a Roth IRA, your investments grow tax-free if you follow retirement rules. Step 3. Fund your account. Link your bank account and transfer money. Most platforms allow automatic transfers, which is highly recommended. Step 4. Make your first investment. Don't overthink it. Start simple. The goal is action, not perfection. Remember, the first investment is often the hardest emotionally, but once you take that step, everything becomes easier. What should beginners buy first? This is where many beginners get confused. Should you buy individual stocks? Or something else? While buying individual companies can be exciting, it also carries higher risk. If that company performs poorly, your investment suffers. That's why many experts suggest beginners start with ETFs, exchange-traded funds. ETFs are baskets of many stocks combined into one investment. Instead of betting on one company, you spread your money across dozens or even hundreds. For example, the Vanguard S&P 500 ETF and the SPDR S&P 500 ETF Trust both track the S&P 500 index. That means when you invest in them, you're investing in 500 major US companies at once. This provides instant diversification. If one company struggles, others may perform well and balance it out. For beginners, a simple strategy could be investing consistently into a broad market ETF and holding it long-term. No constant trading. No chasing trends. Just steady investing. Simplicity often beats complexity in investing. Biggest beginner mistakes. Finally, let's talk about what not to do. First mistake, trying to time the market. Many beginners wait for the perfect moment. The problem is nobody consistently predicts short-term market movements. Time in the market is more important than timing the market. Second mistake, panic selling. Markets will go down. That's normal. Selling during fear locks in losses. Long-term investors stay patient. Third mistake, chasing hype stocks. Social media often promotes hot picks. Investing based on hype rather than research can lead to losses. Fourth mistake, investing money you need soon. If you'll need the money within a year or two, it shouldn't be in volatile investments. And finally, emotional investing. Fear and greed drive bad decisions. Having a simple, consistent strategy helps you avoid emotional mistakes. Investing success is not about being the smartest person in the room. It's about discipline, patience, and consistency. Before we close this video, I want you to take a moment and think about something very simple but very powerful. 5 years from now, you will either look back and be grateful that you started investing today, or you'll wish you had. The difference between those two futures isn't luck. It isn't intelligence. It isn't even income. It's one decision. The decision to start. You don't need to be an expert. You don't need to predict the next big company like Apple Inc. or Amazon. You don't need thousands of dollars sitting in your bank account. What you need is consistency, a simple plan, and the patience to let time do the heavy lifting. The stock market has rewarded disciplined, long-term investors for decades. The S&P 500 has gone through crashes, recessions, wars, inflation, and global uncertainty, yet over the long run, it has continued to grow. Why? Because businesses innovate, economies expand, and ownership in strong companies builds wealth. The biggest risk isn't starting small. The biggest risk is doing nothing. So here's your action step. Open your brokerage account. Fund it with whatever you can. Even if it's just $50 or $100. Choose a simple diversified investment. Set up automatic contributions. And then stay consistent. Ignore the noise. Think long term. Financial freedom isn't built in a day. It's built through habits. If this video helped you understand investing more clearly, make sure you like this video so more beginners can see it. Subscribe for more simple, powerful finance content. And comment. Start below. If you're serious about beginning your investing journey today, your future self is watching. Make them proud.